Hey everyone, and welcome back for another deep dive.
Yes, welcome back.
Today we're going to be talking about industrial software.
That's right. We are going to be looking at PTC's first quarter 2025 earnings call.
All right, so I got to say I was pretty impressed.
Oh, yeah.
Yeah, they exceeded their Q1 guidance.
Yeah, and especially with all this talk about a possible recession.
Exactly.
Like, it's really impressive.
Then they had that great line about getting your digital house in order, which I thought was very catchy.
It is catchy, for sure.
So let's dive into some of the details.
Sounds good.
One of the things that they are really focused on is ARR, or annual recurring revenue, and free cash flow.
Yes, and that makes a lot of sense because they're really transitioning to a subscription model.
Yeah, it's kind of like, when you subscribe to Netflix or any other streaming service.
Right. You pay that regular fee and you get access to all the software.
And speaking of growth, they are undergoing a major transformation in how they go to market.
Yes, they are shifting to a much more targeted, industry-specific strategy.
So instead of trying to be everything to everyone, they're really focusing on where their software can make the biggest difference.
Exactly. And those industries they're going after are industrial products.
Okay.
Aerospace and defense.
Makes sense.
Automotive,
Mm-hmm.
medical technology and electronics and high tech.
Got it.
And those are all sectors that are seeing an explosion in product complexity and where software is becoming absolutely essential.
Absolutely. And to lead this charge, they've even brought in a new chief revenue officer, Dada.
Yeah, he's got a ton of experience in enterprise software.
Oh, wow. So that's a really big deal.
He is known for being able to successfully implement go-to-market strategy.
That's awesome. And they've also added some other key leadership roles,
Yes, they have.
like in marketing, sales enablement, and customer success.
Right, and this shows how serious they are about making this new vertical strategy work.
Yeah, they're not messing around.
No, they are not. They're putting their money where their mouth is.
But this is a big change,
It is.
so it's going to take time.
Yes, it will. They've even said that they don't really expect to see the full impact of this until later this year.
It's definitely a long-term plan.
It is, and I think that's important for investors to understand.
All right, so we've talked about the big picture stuff, but now let's zoom in on their product strategy.
Yeah, let's take a look.
They're still really focusing on their 5 core product areas: PLM, ALM, SLM CAD, and SaaS.
That's a mouthful.
I know, right?
Yeah.
And it's great to see that they're not just maintaining these products,
Right.
they're really pushing the boundaries with a ton of new updates and features.
They are doing a lot of interesting things.
So let's get into some specifics.
Okay, sounds good.
First up is Windchill, which is their flagship product for managing product lifecycle.
Yes, and they're extending its capabilities all the way from the design phase to the shop floor.
Oh, wow. So they're connecting the digital world with the physical world.
Exactly. Designers can create digital work instructions,
Mm-hmm.
and those can be delivered directly to workers on the factory floor.
In real time.
In real time, exactly.
So that has to be a huge boost for efficiency.
It really is. It helps streamline communication.
Okay.
It produces errors, and it allows companies to adapt to change much faster.
Okay, so that's Windchill. What else is new on the product front?
Well, they also talked about CodeBeamer,
Okay.
which is their platform for application lifecycle management, or ALM.
Right, and this is all about managing software development, which
Mhm.
is becoming increasingly complex,
Exactly. And it's also more and more intertwined with product development.
especially with things like cars, medical devices, even appliances. Everything's becoming smarter and more connected these days.
Exactly. Software is playing a bigger role than ever.
So CodeBeamer is PTC's answer to that trend?
Yes, it is. They're making it more scalable, more capable, and more tightly integrated with their other products.
And let's not forget about ServiceMax, their field service management platform.
Oh, yeah, that's right. They just achieved a key certification called FedRAMP.
That's a big deal
It is.
because it opens up a whole new market for them.
The federal government.
That's a lot of potential customers.
It is. And it shows that PTC is thinking strategically about where to expand their business.
And then there's Creo, their flagship CAD software.
Yes.
They made some really cool advancements in design capabilities,
Hmm.
particularly for working with composite materials.
Yeah, you see those becoming more and more popular in aerospace and automotive industries.
And they also mentioned Onshape, their cloud-native CAD platform.
Yeah, which is the only one of its kind in the industry.
And they're still releasing updates at a rapid pace.
Right. They're constantly improving it.
So it seems like they're really pushing the boundaries of what's possible with CAD software,
Right.
both on premises and in the cloud.
Yes. And the message here is that PTC is not just sitting back. They're actively innovating and trying to push the boundaries.
That it has to be exciting for their customers.
It is, especially for those who are looking for really cutting-edge solutions.
Okay, so we've covered a lot of ground already. Their strategic shift, their impressive product updates.
Right.
But there's one more thing we need to talk about.
Yeah.
And that is AI, artificial intelligence.
Now we're talking. This is where things get really interesting.
PTC is betting big on AI.
They are.
And they even say that they have a secret sauce that sets them apart.
A secret sauce. I like it.
What is it?
It's their deep understanding of product data. They've been collecting and analyzing it for decades.
So they're not just jumping on the AI bandwagon, they're applying it in a practical way.
Right. They want to use it to actually solve real-world problems.
And they have a ton of data to work with.
Yes, they do, which gives them a big advantage in developing effective AI solutions.
Okay, so let's dive a little deeper into how they're using AI to enhance their products and create new ones.
Sounds good to me.
Yeah.
Exactly.
Okay.
They're really focusing on areas where AI can make a difference, not just trying to use it for everything.
Okay, so they're being strategic about it.
Yes, very much so. And one thing that's really interesting is how they talk about their AI offerings as assistants.
The system.
Yeah, because that's really what they are designed to be.
Okay, I like that.
They're there to help customers make better use of their data.
So like instead of having to dig through tons of data themselves, AI can do the heavy lifting.
Exactly. It's like having a super smart research assistant
I like it.
who can quickly find the patterns and insights that would take humans forever to find.
Okay, so you're saying AI can help us be more efficient and make better decisions.
That's the idea. And one of the most exciting places they're using AI is in ServiceMax.
Okay, their field service management platform.
Right. They're actually launching ServiceMax AI very soon.
Oh, wow.
Yeah. And it's got features that are going to totally change how companies schedule appointments, dispatch technicians, manage their workforce.
Well, that's huge for any company that relies on field service.
And get this, they're even introducing a new pricing model specifically for their AI offerings.
Okay, that's interesting. Why?
Well, one of the biggest barriers to people adopting AI is the cost.
Yeah, that makes sense.
So by making it more affordable, they're hoping to encourage wider adoption.
That's a really smart move.
And they're not just working on this alone. They're actually partnering with some big names like Volkswagen and Microsoft.
To develop AI features for their Codebeamer platform.
Exactly. They want to tap into the best minds in the industry
Makes sense.
and bring the most powerful solutions to their customers.
It's clear that they're really thinking strategically. They've got these partnerships, they're focused on specific industries, and they're developing cutting-edge technology.
They're definitely firing on all cylinders.
Okay, well, let's shift gears a bit and talk numbers. How did they actually perform in Q1?
Well, despite the tough economy, they had a pretty strong quarter.
Okay, give me the highlights.
Their ARR grew by 11% year over year, hitting $2.277 billion.
Wow, that's impressive given all the talk about a slowing economy.
It is. They even mentioned a sluggish selling environment.
Okay, so what drove that growth?
Well, a few things. The timing of their deferred ARR recognition played a role, and they also had a couple of contracts churn, but they expect those to come back later this year.
So just a small hiccup.
Yeah, exactly. Nothing to be worried about.
What about free cash flow?
That was even better, up 29% year over year
Really?
to $236 million.
Wow, so they're not just growing their revenue, they're also generating a lot of cash.
Exactly, and that's essential for any business.
They did mention some outflows, though.
Yeah, about $11 million related to their go-to-market realignment.
Okay.
Severance and consulting fees, that kind of thing.
But they made it clear that this isn't about cost cutting. It's about investing for the future.
Right. The streamlining their operations, but also building for growth.
It's a balancing act for sure.
Now let's take a look at the breakdown of their ARR growth by product groups.
Okay, that's good.
Their CAD segment, which is primarily driven by Creo, saw a solid 9% increase year over year.
And their PLM segment, which
Now-
includes Windchill, Codebeamer, IoT, and ServiceMax.
Right. That one grew by 11%.
So pretty healthy growth across their portfolio.
Yeah, and they're seeing it geographically too. 9% growth in the Americas and a strong 12% in both Europe and Asia Pacific.
So they're really a global company.
Yes, they are, and their subscription model is helping them weather the economic storm.
How so?
Well, their churn rates are low,
Okay.
and their customers are the type that prioritize R&D even when things get tough.
That makes sense.
It creates a pretty stable base for them.
Now, what about their cash position and debt?
Well, they ended Q1 with $196 million in cash and cash equivalents, and their debt was at $1.548 billion.
Okay, and what's their leverage ratio?
It's at 1.7 times, so not over-leveraged.
Good, and they've got a decent amount of cash on hand.
And they're being proactive about managing their debt. They're paying it down, and they're also buying back shares.
Okay.
In Q1 alone, they reduced their debt by $205 million and bought back 383,000 shares for $75 million.
So they're returning value to shareholders.
Right, and they've got a $500 million bond maturing in February, which they plan to pay off using cash on hand and their credit facility.
Okay, so they've got that covered.
Yeah, they're on top of it.
Well, it sounds like they're in a pretty good position financially.
Yeah, I'd say so.
So what's their outlook for the rest of the year?
Are they sticking with their guidance even with all the uncertainty in the economy? They are.
Right.
They're still guiding for constant currency ARR growth of about 9% to 10% for fiscal year 25, and they expect about 9.5% growth in Q2.
So they're not backing down from their growth targets.
Nope, they're confident.
And just to be clear, those ARR figures are based on their fiscal 25 plan exchange rates.
Right, as of September 30, 2024. So they've already factored in currency fluctuations.
What about their free cash flow guidance?
They're projecting free cash flow of $835 million to $850 million for the year.
Okay, and that includes the $20 million in cash outflows for their go-to-market realignment.
Right, so they're still generating a lot of cash even after those expenses.
And they're expecting their usual seasonality with about 60% of their free cash flow coming in the first half of the year.
But interestingly, Q4 is projected to be their lowest cash flow quarter.
Why is that?
Well, they're expecting about $270 million in free cash flow for Q2, which includes $4 million of the total $20 million for the go-to-market changes.
Yeah, it's amazing how detailed their planning is.
It is. They really break it down.
Now, their cash flow guidance isn't on a constant currency basis, right?
That's right. So exchange rate fluctuations could affect those numbers.
But they do have a natural hedge.
Yeah, about 45% of their ARR and 35% of their non-GAAP costs are in foreign currencies.
So that provides some protection from big currency swings.
Right, it does.
So they're keeping an eye on exchange rates, but they're not too worried.
Well, they did say that, changes in FX, interest rates, tax regulations, those are all hard to predict. But they're pretty confident in their forecasting process.
Okay, why is that?
Well, they have very predictable cash collections and a disciplined budgeting structure.
They're known for their financial discipline.
Exactly. And their billing practices also contribute to that predictability. They bill annually upfront, regardless of the contract length.
So their cash flow is more consistent and easier to compare over time.
Right. And their budgeting process is designed for predictability and agility.
How so?
Well, they start each fiscal year by funding growth at the low end of their internal ARR forecast.
So they're being conservative.
And then as the year progresses, they adjust that funding based on how things are actually going.
Okay.
If growth is strong, they'll invest more. If things slow down, they'll pull back a bit.
So they're able to adapt to the market conditions.
Exactly. And this approach allows them to maintain predictable free cash flow without missing out on growth opportunities.
It sounds like they have a really solid system in place.
Yeah, they've really thought this through.
So what are their long-term financial goals?
Well, over the medium term, they expect their free cash flow to grow faster than their ARR.
Okay.
And they project their non-GAAP operating expenses to grow at about half the rate of ARR.
So they're forecasting operating leverage.
Right. As their recurring revenue base grows, their profit margins should improve.
That's the beauty of the subscription model.
Exactly. Now, they did provide some guidance on revenue and EPS, but they really emphasize that those numbers are less reliable under ASC 606 accounting rules.
So they're really pushing analysts and investors to focus on ARR and free cash flow.
Yes, those are the best indicators of their true performance.
Okay, let's dive into their net new ARR performance.
All right, so to hit their 9.5% growth target for Q2, they need $44 million in sequential net new ARR growth.
So that's a pretty specific goal. How confident are they?
Well, it's impossible to predict any given quarter with that level of precision.
Yeah, of course.
Especially with the macro environment being what it is and all the changes they're making to their go-to-market strategy.
There's definitely some volatility there.
Right, and historically, their net new ARR has fluctuated from quarter to quarter.
Okay.
Due to things like timing of bookings renewals and that deferred ARR recognition we talked about.
So it's not always a smooth ride.
No, but the good news is they're expecting churn to stay low throughout the year.
Okay, that's positive.
And all their investment decisions are guided by their full-year net new ARR growth forecast.
So they're not getting caught up in short-term fluctuations. They're focused on the big picture.
Exactly. Now, for the full year, They need $214 million in net new ARR to reach the midpoint of their guidance range.
And how does that compare to previous years?
Well, at the midpoint, they'd be adding about $20 million less net new ARR this year compared to last year.
Okay.
And that's also about $5 million less than in fiscal 23 and 22.
So their growth is moderating a bit.
But you have to remember that last year they benefited from about $10 million in incremental deferred ARR.
Okay.
So if you adjust for that, their fiscal 25 guidance actually suggests roughly flat net new ARR growth compared to the past 3 years.
So they're essentially holding steady in a tough market.
Exactly. And that's why they're making these changes to their go-to-market approach.
It makes sense. They need to adapt to keep growing.
Right. They want to end this year with momentum so they can really drive net new ARR growth in 26 and beyond.
Smart move.
And while they're making these changes, they've got a solid foundation in their business model. You know, their low churn, their strong customer relationships, that gives them stability.
And they're sticking with their 9% to 10% constant currency ARR growth guidance for the year.
Yes, they are.
So it sounds like they're in good shape.
They are. They have a great product portfolio, strong operational discipline, and they're really good at finding and capitalizing on opportunities.
It's clear they have a vision and a plan to achieve their goals.
Now, before we wrap up this part of the deep dive,
Okay.
let's take a quick look at their investor relations calendar.
Oh, yeah. It's always good to know when and where they'll be sharing their insights.
So in February, their CFO, Christian, will be at the Baird conference in Utah,
Okay.
and their head of investor relations, Matt, will be at the Wolf conference in New York.
So they're covering both coasts.
And in March, their CEO, Neil, will be joining Christian and Matt at the Morgan Stanley conference in San Francisco.
That's a big one.
It is.
Any other events on the horizon?
Yeah, in March, Christian and Matt will also be at the LOMP conference, which is virtual,
Okay.
and the Stifel conference in New York.
So they're keeping busy.
They are.
It seems like they're really committed to being transparent and communicating with investors.
Absolutely. They're very accessible.
Okay, so we've covered a lot of ground today. Their strategic vision product, roadmap, financial performance growth prospects.
Yeah, it's been a deep dive for sure.
But there's one more piece of the puzzle we need to look at.
You mean their go-to-market transformation?
Exactly, that big shift to a vertical-focused approach.
That's where things get really interesting, and it's key to understanding how they plan to achieve their ambitious growth targets.
All right, lead the way. Let's unravel this go-to-market puzzle.
Huh.
Okay, so let's talk about this go-to-market transformation.
Yeah.
What does it actually mean for PTC? And more importantly, what does it mean for you, our listener?
So basically, they're moving away from that one-size-fits-all approach and becoming laser-focused on specific industries.
Okay.
You know, instead of just selling software, they want to be seen as trusted partners
Okay.
who really understand the ins and outs of your industry. So they're tailoring their solutions, you know, even their sales teams, to speak directly to the challenges and opportunities that businesses in those industries face.
So they've identified these 5 key verticals: industrial products, federal aerospace and defense,
Right.
automotive, medical technology and electronics, and high tech.
That's right.
What is it about these industries that makes them so special for PTC?
Well, these are the sectors where product complexity is just exploding and software is becoming absolutely mission critical.
Yeah, you think about the software that goes into a car or a fighter jet or a medical device.
It's crazy.
It's mind-blowing.
It is.
So is PTC basically saying, we get it, we understand the pressure you're under, and we have the solutions to help?
Yeah, exactly. They're saying, we speak your language. We understand your challenges, and we can help you navigate this increasingly complex world.
But they're not just talking about it. They're actually restructuring their whole sales organization.
Yeah, they're putting their money where their mouth is.
So they'll have people on the ground who really understand those specific industries.
Exactly. People who can build trust and close deals.
And it's not just sales. They're also overhauling their marketing to be more targeted.
Yes, they are.
So their messages are going to resonate more with potential customers.
Exactly. No more generic pitches.
Right.
It's all about showing how PTC solutions can solve real-world problems in your industry.
And to lead this charge, they brought in Rob Dada as their new Chief Revenue Officer.
Yeah, he's a veteran in the enterprise software world.
He's got a great reputation.
He does.
So they're obviously expecting big things from him.
They are, and they're giving him the support he needs.
Okay, how so?
Well, they've created all these new leadership roles in marketing enablement, customer success.
So they're really building a whole ecosystem around this new strategy.
They are.
It's ambitious,
It is.
but it's also risky.
It is. There's always a chance that it won't work out.
So have they addressed that at all?
They have. They've been very upfront about the fact that this is a journey, you know?
Yeah. Okay. And they don't expect to see the full impact of it for a while.
So they're in it for the long haul.
Yes, they are. And they're willing to invest what it takes to get it right.
So for our listeners, what's the key takeaway here?
I think the key takeaway is that PTC is making some big changes to become more valuable to businesses.
Okay.
They're not just selling software anymore. They're selling a vision of the future where they are deeply embedded in your industry,
Okay.
understanding your challenges and providing tailored solutions to help you succeed.
So it's a pretty exciting time for PTC and their customers.
It really is.
Now, before we wrap up this deep dive,
Yes!
it's time for our favorite segment.
This is not financial advice.
Remember, folks, we are not financial advisors.
This is just for fun.
So don't blame us if your portfolio does something crazy after listening to this.
All right, you ready for this?
I'm ready. Hit me.
Okay, so we know PTC is betting big on AI, right?
Yes.
And they're targeting industries where their software can have the biggest impact.
But what if they take it a step further and start developing AI models that can predict the future?
Whoa, predict the future.
I know, right? It sounds crazy.
What do you mean, like predict what kind of products will be in demand or what problems will need to be solved?
Exactly. Like imagine an AI that's been trained on decades of data from the automotive industry, and it can tell you what kind of cars people will be driving 10 years from now.
That would be incredible.
It would be game-changing for car manufacturers.
They could make smarter decisions about everything.
Exactly. Product development, supply chain management, even marketing.
And PTC could charge a premium for access to these predictive AI models.
Oh, yeah. It would be a whole new revenue stream for them.
So here's our outrageous but plausible trade idea.
Okay, I'm listening.
Buy PTC stock,
Okay.
but set a price alert for whenever PTC mentions predictive AI in an earnings call or press release.
Because if they even hint at moving in that direction, their stock could skyrocket.
It's like a secret code.
Exactly.
But just remember, this is pure speculation.
It is.
Not financial advice. Do your own research, and don't blame us if you lose all your money.
We warned you.
But if it does happen, you heard it here first.
That's right.
All right, that's it for our deep dives into PTC's Q1 2025 earnings call.
Thanks for joining us.
We'll be back next week with another exciting deep dive into the world of business and technology. Until then, keep learning, keep exploring, and keep those outrageous trade ideas coming.